Hello there. The second part of lecture series 22 will look at other employee benefits within the scope of IAS 19 employee benefits, starting with termination benefits. IAS 19 requires termination benefits to be dealt separately from other employee benefits, as the event giving rise to the obligation is as a result of termination of employment rather than employee service. Termination benefit arises from an entity's decision to terminate employment or an employee's decision to accept an entity's offer of benefits in exchange for termination of employment. An entity shall recognize a liability and an expense for termination benefit at the earlier of the date when 1. An entity can no longer withdraw the termination benefit, and 2. The entity recognizes restructuring costs in accordance with IAS 37, provisions, contingent liabilities, and contingent assets. An entity shall recognize termination benefits on initial recognition and shall measure and recognize subsequent changes in accordance with the nature of the benefits. If the termination benefits are expected to be settled within 12 months of the reporting period it is initially recognized, it shall be accounted as a short-term benefit. However, if the termination benefits are not expected to be settled wholly within 12 months of the reporting period it is initially recognized, it shall be accounted as a type of other long-term benefit. In the case of termination benefit that results in an enhancement to post-employment benefits, the entity shall apply the requirements for post-employment benefits. Next, we will look at post-employment benefits. These are employee benefits payable after completion of employment. It normally relates to retirement benefits. A post-employment benefit or pension plan consists of a pool of assets, normally investments, cash, and properties, together with a liability for pension payment obligation. The return earned on the pension plan assets is used to settle the pension obligation. The two main types of post-employment benefit plans are defined contribution plans and defined benefit plans. Defined contribution plans are post-employment benefit plans where an entity pays fixed contribution into a separate entity. The entity has no legal or constructive obligation to pay further contribution if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and prior periods. Thus, under a defined contribution plan, the actuarial risk and investment risk fall in substance on the employee. Under a defined contribution plan, the reporting entity shall recognize the agreed pension contribution as an expense in the profit or loss. In situations where the cash paid does not equal the value of the contributions due for the period, this shall result in either an accrual or a prepayment. According to IAS 19, defined benefit plans are post-employment benefit plans that are not defined contribution plans. Under defined benefit plans, the entity has an obligation to provide agreed benefits to current and former employees. The regular contribution by the entity to the pension plan will be invested to generate returns. If the investment return is below expectation, the entity is required to make additional contribution to cover the shortfall. Thus, under a defined benefit plan, the actuarial risk and investment risk fall in substance on the employer. The next part of lecture series 22 on IAS 19 employee benefits focuses on accounting for a defined benefit plan.